Okay, in this video, the next video on the Federal Reserve module, first I want to go through what the federal funds rate is. It's just an interest rate, very short-term interest rate. It's what banks charge each other to borrow money overnight. It also turns out to be a very important interest rate that we'll go over later on because it's the interest rate that changes the most when the Federal Reserve does its actions. And then we'll go through the stances of monetary policy, essentially how the Federal Reserve is thinking at the time. Should they be printing a lot of money to stimulate the economy? They should be contracting the economy because of inflation. Okay, so first, the federal funds rate. I'll abbreviate that usually with the FFR. This is the interest rate that banks charge each other to borrow money overnight. Now, why do banks want to charge each other money? Why do they need to borrow money overnight? It's to meet their reserve requirements. So the banks have to have their legal reserves, and they're checked every day to make sure they have enough in reserves. And if they don't have enough, they're allowed to borrow from a bank that has excess reserves. So this interest rate is essentially determined by supply and demand. It is, we'll say, here it is, it's the interest rate banks charge each other. To borrow money overnight. Just to meet their reserve requirements. It's a very, very short-term interest rate. We'll come back to that later on. Now, a few different types of monetary policy. One is expansionary, one is contractionary. They're both kind of extremes. In the middle, there might be some sort of neutral policy. But an expansionary policy is done by expanding the money supply. So, done by expanding the money supply. I'll just write MS for the money supply. And when I say money supply like this, I mean M1 or M2. That's a much better definition of money if we're looking at whether the economy is expanding or contracting. Contractionary monetary policy is done just the opposite way. It's by contracting the money supply. So contracting MS. Expansionary policy is known as a loose policy. It's also known as an easy policy. And the buzzword right now that's used for an expansionary policy is accommodative. So an accommodative, two M's, two C's, two M's, accommodative policy. That means they're being loose. And the Fed says that a lot lately. They've been saying that for the last 10 years, that they're being accommodative. That means they're being expansionary with some sort of loose policy. A contractionary policy is referred to as a tight policy. Now, expanding the money supply, expansionary policy, for the most part, Fed buys bonds through their open market operation. So the Fed buys bonds. And when they start buying bonds, it increases the demand for bonds, which means the price of bonds go up. So price of bonds increase. And of course, when the price of bonds go up, the yield on the bonds go down. So the yields decrease. And the contractionary policy, the Fed is selling bonds. The Fed sells bonds. through their open market operations, open market sales. Bond prices fall, and the yields go up. An expansionary policy has the effect of stimulating the economy. Stimulates economy, at least in the short run, because money is neutral in the long run. So, but it's not neutral in the short run. So it stimulates the economy. And a contractionary policy will contract the economy, slow it down, at least in the short run. Entirely possible to create a recession by contracting the money supply. Now, why don't they just keep expansionary monetary policy going all the time? Well, it causes inflation. Causes inflation, probably, maybe. There is some link there, at least in the long run, that it'll cause some inflation, usually with a lag. It doesn't happen right away. It takes at least a year or two before the inflation finally starts showing up in the economy. And over here for the expansionary monetary policy, we should not be looking at the monetary base. We should be looking at something like M1 or M2. And the same way with contracting the money supply. We should be looking at M1 or M2 rather than the monetary base. Why would the Fed ever want a contractionary policy? Why would they want to do that? Why would they want to do something that contracts the economy? And their only reason that they ever do it, really, is because inflation gets too high. They've got the dual mandate, stable prices, and if inflation starts to get too high, they've got to do something about it. They're expected to do something about it. And that means to try to start slowly contracting the economy, reduce the inflation. It'll take a couple of years for that to happen, and try to do it in a way that they don't force the economy into a recession. Delicate balance, and it takes some time. Now, what should we see if the Fed starts to change their stance? So on one end, we have the accommodative policy. The other end over here, we have a tight policy. And I guess somewhere in the middle, we could have a stance that's neutral. Now, if the Fed is going to start tightening and moving from accommodative to neutral, then we should start to see the money supply drop when we're moving this way. And we should see interest rates start to go up. So interest rates, little I, will start to go up. Now they're affecting the yields on bonds that they're buying. But interest rates in the economy, even though there's a million different types of interest rates, they all tend to go up together and they all tend to come down together. The whole yield curve goes up and down, changes shape a little bit, but for the most part, it's going up and down together. So if the interest rates to buy a house are going up, the interest rates on buying cars are probably going up too. Now, if the Fed is moving from tight to neutral, or neutral to accommodative, we're moving to the left here, then we should see the money supply increase. And, or we should see the interest rates fall. That's in general what we should be seeing. So we're moving towards the right, we're becoming less accommodative or becoming tight, we should see the money supply going down and interest rates start to go up. And if we're becoming looser in the policy, more accommodative, either moving from a tight to neutral or neutral to accommodative, then we should see interest rates falling in the economy. All interest rates falling in the economy. Now, you might think that it's crystal clear as to what kind of policy the Fed has. You might say, well, if the money supply, the monetary base, or M1 is going up, then we're being accommodative. Or have an easy policy. If it's going down, we're being tight. But it's not that clear. And sometimes the Fed doesn't even know if they're being accommodative or neutral or contractionary. In the 1970s, inflation was high, and the Fed thought they were being contractionary. They were trying to do something about the high inflation rates. Economists now know, when they look over the data, that the Fed wasn't being contractionary at all. They were actually being quite expansionary and causing the inflation rate to get worse. So you might think, oh, it's crystal clear, here's what the Fed is doing. No, it's not. Sometimes it's very difficult to tell if they're being expansionary or contractionary. And as I say, they don't even know. They get it wrong sometimes too. So for example, let's say the Fed is increasing the money supply by 6% a year. And then they reduce it to 5% a year. The monetary base is still, or M1 is still increasing by 5% a year. Is that expansionary or is it contractionary when they're starting to slow down the percentage increase? It's not really quite clear. If the interest rate goes up from 2% to 3%, is that contractionary? It's rising. What if the real interest rate is falling? Now, is that contractionary or is it expansionary? Sometimes very difficult to tell. Okay, so in this video, we went through what the federal funds rate is, that very, very short-term interest rate that banks charge each other. And we went through the different stances of monetary policy to understand what happens when the Federal Reserve has a particular stance, or when they're moving from one stance to another between accommodative and tight, or tight to neutral, or neutral to accommodative, or whatever their stance is or trying to move to.